Hello and welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. We'll kick off and talk about the US market. The US dollar remains heavy on concerns and trade uncertainties as US political and economic confidence has taken another hit. Now, the Trump administration is considering cutting the China trade deficit by $100 billion as further tariffs are aimed at China, somewhere to the tune of around $60 to $100 billion worth. We've seen risk trade unwound as a result of all this uncertainty due to the protectionist policies that the Trump administration are talking about. That has seen the Japanese yen and the Swiss franc strengthen in place of the Aussie dollar and the New Zealand dollar as safe currency purchases take hold. Now, the new US Chief Economic Advisor, Larry Kudlow, has spoken about strong US dollar expectations, and his suggestion that no one has devalued their currency to prosperity remains a topical point in time. The impact of the US fiscal uncertainty and the rising deficits, the budget deficit problems in the United States, are clearly a sign of concern. That's the reason why we've seen the US bond yields rise, the 10-year yields approaching that 3% level as we speak. Now, markets are bracing for a US federal rate hike tomorrow on Wednesday. The futures market is pricing it that it's a 95% factored in event. Now, look out for the policy language that the US Central Bank, the Federal Reserve, uses around gradual and timely after they make that announcement on Wednesday night. Now, global growth concerns, because of these trade sanctions and tariffs that we've been talking about, likely to see commodity currencies weaken further. Now, already we've seen the Aussie dollar break through that 78 cents level, which was the 200-day moving average, and it looks like now that it's broken through that 77-cent shackle, it looks like it's going to remain between 76 and 78 cents as we await Thursday's all-important jobs number. Now, today the Reserve Bank of Australia produced its minutes from the March meeting, and the headlines are concerned about high household debt, surprise, surprise, and secondly, they expect that wages growth will rise during the course of this year as jobs market spare capacity tends to lift or begins to lift. So it's a little bit of an optimistic look that as employment picks up, so too will wages growth. Looking elsewhere in financial markets, the euro dollar is weaker. On news that Germany's trade minister, Mr. Altmaier's visit to the US to discuss these ongoing tariff deliberations about steel and aluminium may hamper the Eurozone economy. Now, the ECB President Mario Draghi recently suggested that the ECB is a long way from raising interest rates. Their inflation in the Eurozone remains stubbornly low at 1%, which means monetary policy interest rates will remain where they are for the time being. The sterling pound is a lot stronger. On news that the UK and the EU have agreed to initial terms for this transition process for Brexit, which will be in place until December 2020. We expect the Bank of England will keep interest rates on hold this Thursday when they meet for their regular monetary policy meeting, but they will maintain the tightening bias for future rate hikes. In fact, the market is now expecting a 50% chance that they will raise interest rates in the UK by 25 basis points in May. And last but not least, the Russian Federation President Vladimir Putin has won the election in Russia convincingly for another 6-year term. Have a great week. Don't forget to watch us on Sky Business News every Thursday at lunchtime around 12:15 p.m. for our latest financial markets wrap. Thanks for watching. I'm Tony Boyajian, Compass Global Markets.